Mr. Aloke Bapai, the Chairman and MD and Group CEO of Ixigo, joins us on the show to talk to us about that. Alok, hi, good to be speaking with you. Substantial improvement when it comes to the profitability as well as the overall operational performance. But the question is, where does it go from here on? Do you expect this kind of momentum to actually sustain a doubling of profits on a yearly basis?
Hi, thank you for having us on the show. I think we need to understand the results in perspective of how Ixigo's strategies played out over the last few years. So Ixigo is a company built on a very differentiated strategy in terms of going after the next billion users, which are people coming from tier 2, 3, 4 towns, as well as the aspiring middle class from tier 1 towns. Our core business is driven by verticals like trains and buses, and increasingly with flights. So one of the reasons why we've grown this fast in FY24 and also in the last quarter is that our flights business has really started to take off as a result of cross-selling and upselling within our massive user base of 480 million annual active users. So if you see our segment growth in flights on passenger segments booked, about 77% growth that we saw year on year. And even for the quarter, it was about a 42% increase in volumes that we booked for the flight side. This is in an environment where the overall domestic flight market was growing only in single-digit percentage in Q4. And even in Q1, the overall market has continued a very muted growth. But I think we are managing to take share because of the fact that there's a lot of first-time flight bookers that come from our user base. A lot of tier 2, 3 flight bookers coming from airports like Ayodhya, Darbhanga, Jharsuguda, Bareilly, etc., right, which continue to help us grow faster than the market on that side. On trains, I think we've maintained the kind of secular growth we were seeing, which is for the quarter, you will see that our passenger segments have grown close to 15%. And I think going forward, also maintaining some kind of low teens to mid teens kind of a growth here is possible, given that we are the dominant OTA in this space and we continue to gain some market share there as well. Bus, we have grown in line with the market, maybe marginally better than the market. And we continue to hope to grow in line with the market or marginally better there. So I think the story is very simple, that we want to take market share in categories like flights and buses, where our potential still remains of taking more market share. On trains, being the market leader, we want to just maintain faster than the overall capacity growth. So we want to grow at the low to mid teens level, as we said.
Afternoon, this is Vinny joining in the conversation. I'm going to pick up from where you are ending, right, in terms of the market share. So, right, trains where you already have good market share, like you said, you want to increase your market share in flight and buses. So how will your mix change going forward? What are you anticipating, or what is your internal target for a market share in bus as well as flight? And how does this change the margin scenario for the company then?
Right. So in terms of our mix, right, if you look at it at a GTV level, right, so already that mix has changed and evolved a lot in FY24 versus FY23. I mean, flights has become 34% of our gross transaction value, or the gross bookings that we are doing in the year, whereas it was 27% earlier. Train has come down from 60% to 54% of the GTV, and bus remains, in sort of a 11.5% sort of range there of the in the GTV pie. This is of the overall GTV. The pie chart looks like 34% flight, 54% train, and 11% bus. But if you look at on a contribution margin level, right, train is 44% of our overall contribution margin. Flight and bus together are now the majority of our contribution margin. In fact, bus, our contribution margin, has expanded. Train also, it has slightly expanded. And I think there we are seeing now these two categories, flight and bus, are now majority of our contribution margin. Going forward, what we expect is, we want to sacrifice a little bit on the contribution margin percentage we are seeing on flight and bus, which is pretty healthy today, but we are okay letting go some of that in pursuit of faster growth over the next few quarters. And I think that's because there is scope to grow on our market share. Bus is an underpenetrated category. There's less than 20% bookings happening online. I think there is a clear chance to go and get more first-time bookers from people who are booking offline. And flight again, we are not one of the top 3 OTAs there. I mean, we are in the top 5, but we think that we can continue growing faster with this kind of momentum. The problem I foresee is that the overall market on flights isn't growing that fast because capacity is not being added enough. We heard from Indigo that they're adding 1 plane a week. But given the demand trends we are seeing, that may not be enough. So I think muted growth for another quarter or two on the overall market will dampen everyone's growth a bit, although we will grow faster than the overall OTA market there.
But, Alok, the problem with this business is it's a cat business and not really a dog business, and there's no loyalty with respect to customers. They just go to the place which provides you the maximum discounting, etc. Now, with the competition, increasing, and the fact that you're saying that you let go of margins perhaps if needed for the kind of growth that you're looking at, what would it mean for your profitability and margins then?
I disagree. If you look at our strategy in the past, also, we've never been a discounting loss leader in any of the categories we operated in. They've always been bigger aggressors, and yet we have managed to, grow with very limited capital infusion in the past, right? So I think our strategy remains very simple. We want to offer the best customer experience and build the best customer experience using technology and AI. And if you look at our repeat transaction rates, look at it on an annual basis, we've always hovered around 85-86% sort of repeat, on year on year. And I think if we are able to maintain repeat transactions in the 80s, right? We do see enough loyalty to give us confidence that our overall contribution margin will keep growing.
Point. Take that on board. Thanks, Aloke, for making time and speaking with us, and hopeful that we'll have these conversations more often.
If you like this video, then like, share and subscribe to ET Now.